Hello, everyone, and welcome back to the Global Market Update series. We've made it to September in a year that feels both like the longest of my life and a total whirlwind. This month kicks off the CreditSights 25th anniversary celebration, an exciting milestone for the company, and we have a special series of podcast episodes, 25 for 25, interviewing key members of the CreditSights team over the years. These have been really fun for team strategy to do, especially as we are somewhat new joiners to the CreditSights family. If you're interested in those special episodes or the CreditSights podcast, No More Risk Better, you can indicate your interest in getting the link in the survey for this webinar or just by subscribing to our YouTube channel. Today, Zachary and Logan Miller, our head of Euro strategy, will discuss the recent happenings in the financial markets and how recent data and a rapidly devolving U.S. labor market are influencing our thoughts for this year and into 2026. If you haven't seen it, Zach put out a really great report looking at tomorrow's non-farm payrolls report and recent credit market reactions to payrolls. We are trying to edge out Davis Hebert and his NFL preview in top red, so please give that a click so that we can become victorious in the Charlotte office. Later, we'll bring in Mark Leitner, our head of special situations legal research, to discuss some truly special situations, namely the litigation around tariffs, the pending Supreme Court docket, legal implications of Trump intervention in specific companies, and of course, what is happening with the Fed and the legal proceedings related to the recent firing of Governor Cook. As always, we're happy to take any questions. If you have a question, please submit it using the Q&A function on the webcast software. As a special bonus for today, to celebrate CreditSights' 25th anniversary, we want to hear from you. If you submit a favorite CreditSights memory or notable moment from the past 25 years, you may be getting some fun swag in the mail. Being a research analyst can sometimes be a lonely business. We put out a lot of content into the world and often wonder who's reading this and what do they think? And we love to hear any and all feedback. It helps make us better. And of course, I know that some of you have been already using them, but we do have those emojis to react in real time. Give us a thumbs up, give us a clap, give us a thumbs down if you really don't like what we're saying, and we'll try and take that into consideration. All right, first, let's get into our first audience question of the day. We do have tomorrow with the non-farm payrolls report, and we've had some kind of bumpy labor market data lately. So we would love to hear from you. What is your current assessment of the U.S. labor market? Is it solid but weakening, solid and stable, solid and strengthening, weak and weakening further, weak but stable, and weak but likely to strengthen? Let's go ahead and submit your votes, and we will wait for the audience to do that. All right, we're already getting a shout out in the Q&A box, so thank you, much appreciated. All right. I'm just going to give it another couple of seconds. Okay. We got over half of attendees submitting responses. And survey says, okay, solid but weakening is our top pick, weak and weakening further, second on the list. So it seems like the overall direction from the audience of the labor market is that it is weakening, perhaps from a solid spot, perhaps from a weak spot. So kind of an interesting take there. And like I said, Zach did put out a really great non-farm payrolls preview, which you should definitely check out. All right, getting into market commentary. I think August surprised a lot of people as it was a really strong one for risk. It can seasonally be a little bit weaker, but we did see good gains in small cap equities, which managed to pull themselves into positive total return territory for the year. S&P 500 followed for the second best performer on the month, and then maybe surprisingly, given somewhat defensive nature, U.S. mortgages took the third spot. U.S. corporate credit was a bit lower on the list, though U.S. high yield still posted a respectable 1.2% total return gain, while the U.S. IG market was at 1.1%. At the other end of the spectrum, euro and sterling markets came under some pressure. We had a mix of fiscal concerns and political risk, especially in France and the UK with budgets. Euro IG and high yield managed to eke out modestly positive total returns on the month, while sterling IG was slightly down on rising gilt yields. And speaking of rising yields, we've got another question from the audience. Where do you expect the 30-year Treasury yield to finish 2025? Above 5% or below 5%? We've seen some chop in the long end of the US Treasury market as of late. We had the 30-year Treasury climbing back toward 5% recently. Not great for my TLT position, but you win some, you lose some, before retreating on some weaker jobs data. We would love to hear yields are going to end up in 2025. Also curious if you have feedback in the chat box on what that driver is. Is it inflation? Is it institutional instability? A selling of treasuries by non-US investors? We'd love to hear what your thoughts are there. All right, we'll give it one more second and then we'll go ahead and see what our survey says. All right. Wow, almost an even split, but 57.8% of the audience thinks that we are moving below 5% and holding below 5% for their 30-year Treasury to finish 2025. Zach, I'd love to hear from you. What do you think of the audience's responses? And then also, what's happened in US credit markets lately?
I think it's interesting, Winnie, to see the relatively even split there. It feels like even just this week, we've had a tale of two halves of the week, with kind of the first half focused on yields really across the globe, moving higher at the long end, and now we're already back below 4.9% on the 30 years. So I think there's definitely reason to have concern, and we've seen some pretty dramatic steepening of the Treasury curve, various curve segments, and that certainly pertains to August as well as this year. And I think that highlights some of the concern that even if we do get Fed rate cuts sooner rather than later, that may only pull the front end lower while the long end may lag. So I think I've been a little bit more comfortable, or taken more comfort in the fact that the 10-year is still around 4.2%. That doesn't suggest a crazy concern in terms of the future demand for treasuries, but certainly keeping an eye on the steepening of the 10s 30s curve, which has historically been the more highest correlated to kind of large and worsening deficits. Okay, so getting into the investment grade and high yield corporate credit markets, I'd say August was kind of a decent microcosm for our market expectations going forward. Excess return was pretty uninspiring at just slightly negative for investment grade, while total returns were strong, as Winnie kind of outlined, with 1% in IG and high yield actually outperforming with a 1.2% total return on the month. If we look at what performed well from an excess return perspective, it was really just up in quality, with only AAAs producing 10 basis points of excess return in the IG market, and kind of a super barbell would have performed well from an excess return perspective, with the 10+ year part of the curve really delivering the most for investment grade. When we look at it from a total return basis, and for our subscribers, they know that we have moved to a more neutral recommendation on US interest rate risk, as we think that in general the Fed is now potentially going to be cutting from a behind the curve perspective. And when we think about what our base case is for rate cuts, is we think that kind of pulls yields across the curve lower, not looking for that dramatic steepening that I highlighted as a risk. And when we look at performance in August, really the BBB space produced the most solid total returns at 1.1%. Curve performance from a duration perspective was a little bit more mixed, with really the belly doing the best with 1.5% returns in the 5 to 7 year space. Across high yield, total returns were strongest in CCCs, so we saw a solid 1.6% total return, while distressed lagged. And so when we think about August and kind of putting it together with what we're expecting from the non-farm payrolls report that Winnie outlined earlier, it's really interesting to see we had a similar downside surprise last year, while markets have been much more resilient around that non-farm payrolls report. And we think that leaves the market today set up for being more vulnerable to another downside surprise on non-farm payrolls. And so we go through some of that in detail, look at some of the historical NFP surprise betas relative to corporate credit, and what we think you need to see to keep our 50 basis point rate cut call on the table for September. Oh, sorry. With that, I will turn it over to Logan. Sorry, Logan.
No worries. Thanks, Zach. Yeah, welcome everyone. So yeah, August, like Zach mentioned, was really a month of two halves for European credit, with limited supply in the first 2 weeks of the month, coupled with pretty strong inflows, really pushing spreads across Euro IG and high yield to new cycle tights. Euro IG traded as tight as 76 basis points, while high yield spreads rallied to 260 bips by mid-August. Before primary market activity really started to heat back up, just as political concerns across Europe resurfaced. On the latter topic, political uncertainty in Europe once again took the spotlight at the end of August. First was the Dutch government no confidence vote, which the current caretaker government ultimately survived. But the current government now faces general elections on October 29th. So continued kind of uncertainty around the political landscape, but arguably more important for markets at present, considering last year's election-induced volatility, is the upcoming confidence vote in French Parliament, which happens to be next Monday, September 8th, which was called by Prime Minister Bayrou amid opposition against his spending cuts and tax increases proposed for the 2026 budget. The consensus expectation now is that Bayrou will not survive the confidence motion next week and will be forced to resign. However, I think what ultimately matters for European markets and French risk assets is what happens after the dissolution of Parliament, and whether President Macron can dodge another snap election, which opposition parties such as the RN seem to be pushing for. So ahead of next week's vote, we did see a wave of French issuers tapping the euro primary market towards the end of August, although most deals did see fairly strong demand at slightly higher than expected concessions. So ultimately, over the course of August, euro IG spreads did leak wider by about 5 basis points, ending the month at 85 basis points. High yield spreads closed 16 bips wider to end at 290 bips. But perhaps more pronounced were some of the developments that Zach alluded to in terms of 30-year bonds. We did see, mounting pressure on total returns, particularly at the long end of the curve, with yields really hitting their highest levels in the post-Great Financial Crisis era for boons, and in the case of 30-year gilts, the highest level since 1998. So this resulted in a pretty pronounced steepening of credit curves, and like I mentioned, underperformance in long duration credit, with IG 10 plus years posting total return losses of 0.9% in August, and excess return losses of around 45 bips over the past month or so. That said, the rest of the curve was actually largely intact from a total return perspective, even as we did see spreads widen out modestly across the board. And then in high yield, high yield actually came out mostly unscathed last month, as we saw positive total returns across double Bs and single Bs, although volatility in several special situations credits did weigh on triple C performance last month. And we don't have it on the screen. Winnie mentioned it earlier in her opening comments, but the sterling market certainly bore the brunt of the repricing in gilt yields, with total return down about 0.5% in August. We did write a piece yesterday outlining that we thought that recent dislocations in the gilt market has created an opportunity for sterling IG total return investors to selectively add duration to credit portfolios. And the short message there is that we think sterling IG bond prices and duration are now obviously considerably lower than they were back in the 2022 mini budget sell-off, with total return break-evens for sterling IG also significantly higher versus that period. So to us, this implies less sensitivity to another leg higher in gilt yields from already elevated levels. That being said, we're still remain quite cautious on credit overall from a spread or excess return perspective, as we still think that valuations are still too tight. And with that, I'll pass it over to Winnie to talk through EM.
Too tight for sure. And thanks, Logan. Before I get into EM, I did want to address an audience question, which is there any data on the private credit market default update? Yes, indeed. I actually was looking at this yesterday in preparation for another presentation that I'm doing. And our colleagues on the Fitch Ratings LevFin team have a great portfolio of privately monitored ratings companies that they look at that are very traditional kind of middle market type loans representing private credit. And the default rate there has not been great as of late. As of the end of Q2 2025, defaults have ticked up to 9.5%. For context, that's about 150 basis points higher than the end of 2024 and nearly 3 times higher than 2023, where defaults were just 3.62%. That does represent about 28 issuers having some sort of default event. And I would note that that number is elevated, a little bit eye-popping, but also we do need to keep some context in mind. Private credit still has covenants, which does make it easier for a company to default. Some of these private credit defaults that we've been registering over the past 12 months or so are actually par recoveries. So if it is a distressed issuer extending maturity, that is a par recovery, but still a technical event of default. So that is something to kind of keep in mind in terms of the default rate going up, but default losses actually not necessarily as bad as that default rate would indicate. I think a lot of people are looking at private credit, trying to figure out what's going on in that cycle. There's been a lot of headlines lately around private credit, private equity, opening up private credit to retail investors. And it does seem like that asset class continues to be somewhat frothy, especially as we see default rates rising. So great question there. All right, let's talk a little bit about the EM, sovereign and credit market. So EM spreads were a little bit sideways over the month as sovereign spreads were mixed, widening about 2 basis points in IG, tightening 2 basis points in high yield. Yields benefited from falling U.S. Treasury yields, moving 18 basis points lower in sovereigns, 27 basis points lower in EM credit, and that did extend the very solid total returns for the year in both asset classes. Now, if you haven't checked out our EM strategy page lately, there's a lot of great content out there from Regis Chatelier, who recently upgraded Chile to outperform and highlighted the prospects for Morocco to achieve rising star status. He also updated his Latin American tear sheets, which are a great one-page overview for Argentina, Brazil, Chile, Colombia, the Dominican Republic, Mexico, and Peru. We realize there's been a lot of focus this year on LATAM, so these tear sheets are a great cheat code for understanding some of the largest issuers in the region. All right, Zach, let's talk quickly about U.S. sectors. What happened in USIG and high yield from a sector basis over the past month?
Thanks, Winnie. So we had pretty dispersed performance in the U.S. investment grade market from an excess return perspective, and I think that really drives at one of the messages we were communicating on a client call yesterday, that it seems to be more of a credit pickers market versus a market where sector strategy overall is really in a position to provide alpha to portfolios. But just looking at performance in general, IG transportation outperformed with a 0.2% month-over-month gain. The other sectors that produced a decent excess return on the month were energy, insurance, media, retail, utilities, and basics. The major underperformers included consumer goods, telecom, banking, capital goods, and financials. Just dissecting some of those larger moves, we had a big move by Coty bonds, and the Keurig Dr. Pepper bonds drove the weakness in consumer goods. Of course, there's plenty of news out on Keurig Dr. Pepper, with it announcing a deal to buy JDE Peet's. Our analyst Jim Dunn came out with an underperform recommendation on the credit on 8/24, so check out his coverage on that one. Telecom saw weakness on, shifting to U.S. high yield, we saw outperformance by energy, healthcare, and telecom, but in general, we saw total return performance a little bit more uniform in the positive direction. In August, as you did kind of see that tailwind from yields moving lower across the curve, it was a pretty notable bull steepening as we had more expectations for rate cuts sooner and kind of the back end lagging that outperformance. The underperformers in the high yield market were transportation, leisure, technology, and electronics, and capital goods. And I will turn it back to Logan.
All right, yeah, so I'll run through Euro sector performance real quickly. I'll keep my comments brief because I do want to get to the more interesting stuff with Mark around legal procedures. But like I mentioned earlier, the bigger story last month was really around sovereign yields and obviously the boiling political situation around Europe. But in general, I'd say it reflected a mix of caution around duration and obviously somewhat of a weaker sentiment towards French political risk. For instance, Leisure underperformed last month with weakness in several French credits ahead of the confidence vote, as well as a number of issuers coming to market within that sector weighing on spreads. And then in telecom, there's a mix of some exposure to French company Orange, which also priced a fairly sizable deal in August. But also the sector is pretty highly exposed to AT&T's recent purchase or acquisition of EchoStar Spectrum licenses. Pretty sizable, potential bond deal there that remains kind of the second largest issuer in the telecom sector for European markets. And then on the other end of the spectrum, real estate, insurance, and services managed to fare pretty well last month, driven really in part by carry and a lack of sector catalyst to push things wider in sympathy with the overall market. And then down in high yield, media outperformed. It was kind of the big outperformer last month, but it was driven entirely by swings in Telecolumbus's bond, which remains a pretty stressed credit, while autos also closely followed amid a liquidity injection into Antollin's bonds, which popped on that announcement. Meanwhile, cyclical sectors such as basics and cap goods definitely underperformed high yield. We saw a series of weaker than anticipated earnings results across a number of tariff and commodity exposed credits, although weakness beneath the surface did appear fairly idiosyncratic and skewed towards higher levered issuers rather than something more systemic. And with that, I'll pass it back to Winnie.
Thanks, Logan. All right, a quick look at issuance across the US and Euro markets. Global issuance held pretty steady in August. US high yield, Euro IG, and Euro high yield all posted deal volumes ahead of the past 5-year August average. US IG did come in slightly light of that 5-year average at 100 billion, but still had a busy calendar, especially in the second to last week of the month. If you haven't seen, we put out our August new issue recaps and top primary market picks for US and Euro markets earlier this week. We've been asking our analysts to highlight top trade ideas in recent issuance, as we realize that the first month of issue is oftentimes the best time to access liquidity in a deal. So definitely go ahead and check those out. All right, one more audience question on markets. What do you think will be the key driver of credit spreads in 2026? I actually went running this morning with a good friend and portfolio manager here in Charlotte, and we were discussing that unrelenting technical tailwind that has really been driving spreads in 2025 and whether that's going to persist into 2026. So we would love to hear from you. In 2026, are we going to see finally a shift to fundamentals, either macroeconomic or corporate? Is it going to be fiscal policy driving credit spreads as we are seeing outside of the US? Monetary policy, is it just all about the Fed and potential rate cuts? And then finally, technicals, are they just going to continue to be the thing that pushes spreads one way or another? Would love to hear from you. Just give it another couple of seconds. Hey, Zach, we have a question from the audience. Do you want to address this real quick on the week's primary issuance has seen flattening in the 10s, 30s curve in many issuers? Would you expect this to persist given that we've seen weak long end performance this year? Any thoughts on duration?
Yeah, I'd say from a duration perspective, I'd be a little bit surprised to see material flattening in 10s, 30s. If we're talking from a spread perspective, I think that is sort of a different story. But when I think about the 10s, 30s curve in Treasuries around 62 basis points, our historical analysis suggests that given the deficits we have now and are expected to have going, something in the 50 to 55 basis points range is empirically consistent. So I think it's going to come down to inflation expectations and what ultimately happens further out the curve once the Fed delivers rate cuts. But I think to see a sustained flattening move would be surprising from here.
All right, thanks, Zach. Let's go ahead and see what people think about the driver of credit spreads in 2026. All right, this is interesting. We're going to get a return to fundamentals. How exciting. Macroeconomic fundamentals lead the day at 43.7%. And then we have fiscal policy, monetary policy, corporate fundamentals, and technicals at the bottom of the heap. That would really represent a very significant shift from where we've been over the past 12 months. So I think that that is a really interesting take. Oh, some thumbs down here. All right, that's fair. Okay, top reds, real quick. Lots going on here. That AT&T mega deal, top of the list. We've had some of the M&A transactions that Zach mentioned, that Keurig, Dr. Pepper, JDE Peet's. We also have some topics that I think will be relevant to our conversation with Mark today. We have the stakes that are being taken in Intel and perhaps some US defense companies. And then, of course, the tariff ruling, which, you know, love to have some Friday afternoon after market close and news hits also ahead of a long weekend. That's always a fun thing to work through. All right, so we are going to bring in Mark Leitner, our head of special situations legal research, to talk through some of these topics. And first, we would really like to hear from you. The financial press has been making a lot about potential Federal Reserve independence, but the market has not necessarily been reacting so much. If Governor Lisa Cook's dismissal is upheld by the courts, how threatened do you think the Federal Reserve's independence actually is? We're using a scale of 1 to 5, where we have not threatened to very threatened. Would love to hear your responses, so go ahead and submit that. And Mark, as people are submitting their responses, I would love to hear from you. First, just a high-level explainer. How does the Federal Reserve structure and legal protections differ from other independent agencies when it comes to presidential removal powers?
Thank you, Winnie, and good morning, and it's great to be here with you and the rest of the strategy team. The difference between the Fed and the rest of the independent agencies in the federal government is frankly not that different, and that's one of the reasons why people in the market are very concerned. But let me just kind of overview the structure of the federal government and the Federal Reserve within that structure. So the federal government is made up of all kinds of departments and agencies. And some departments and agencies are well understood to be under the direct control of the president. But Congress established a number of agencies that were designed to be somewhat independent of the executive branch of government. They're designed to act independently and without a lot of the political pressures of the change in winds and policies. And so examples of that would be the Federal Reserve, the Securities and Exchange Commission, the Federal Trade Commission, and so forth. And there's a whole bunch of those types of independent, or what we call independent agencies. And one of the hallmarks of those independent agencies is that the leaders of those independent agencies often serve for fixed periods of time, whether it's 5 or 10 or 14 years. And in addition, they are protected in their employment from removal by the executive branch. And so each of the statutes or the laws that govern each of those independent federal agencies typically have provisions that prohibit the firing of the leaders of those independent agencies for things like for cause. In other words, you can't remove those individuals for cause. And so one of the things that's really concerning to the markets right now is that the Supreme Court over the last number of years has basically said that those statutory removal protections are unlawful as they relate to independent agencies. In other words, and it's well beyond the scope of today's discussion, but the court has held that the president has the constitutional power to run a government, right? As people, we elect a president, and the president should have the ability to appoint people to run all of these agencies, both what we have historically understood to be non-independent, but also independent federal agencies. And so that creates a concern because the Federal Reserve also contains very similar protections for the board members from removal for cause. And so when the Supreme Court has, determined that all of those independent leaders or leaders of independent agencies no longer have statutory protections, that put the Federal Reserve in the hotspot, frankly, at least from the market's perspective. So the answer is, in some ways it's very different, but in a lot of ways from a statutory perspective, it's very similar, which is why the markets have been so concerned about what's going on.
Yeah, and looking at the audience, I would say that they are moderately to very concerned about the prospect of Fed independence. Kind of an interesting distribution here. So as we were hopping on this webinar, we did see some headlines around the Department of Justice opening a criminal investigation into the Governor Cook mortgage issues. Mark, can you give us an update, what is the status of that litigation? And then what could be next steps next in the process? What should we be considering from a market perspective?
Sure. So as it's well known at this point, Donald Trump sent Governor Cook a letter last Friday night purporting to terminate her from the Federal Reserve on the basis that she allegedly made false statements on 2 of her mortgage applications that, by the way, predated her time on the board. And then on Thursday of last week, Governor Cook filed a lawsuit in the United States District Court for the District of Columbia seeking emergency relief in a court order reinstating her to her position while the litigation unfolds. So last Friday, there was a big hearing in that district court in DC. No determination came out of that hearing. The judge basically ordered the parties to engage in additional briefing, which they have been doing over the holiday weekend. Governor Cook filed papers with the court on Tuesday. The government is expected to file papers today, and I expect the court to schedule a hearing sometime between today and, let's say, next Friday to determine whether Cook will be able to stay on the board while the litigation plays out, because there's all kinds of issues within the litigation that need to be addressed. But the issue in the immediate term is whether Governor Cook will receive that court order to stay on the board in the interim. And I think that's important. And Winnie, you probably know better than me, I believe the FOMC meets on September 16th. So all the parties involved in the litigation want at least some clarity about what her status will be ahead of that meeting.
Mark, do you have a call on if she will be sitting for that FOMC meeting and voting?
I think it's probably 60-40 that she will.
Okay.
I think given where we're at, it would not surprise me, at least in the interim, that the court granted some kind of short-term relief, but that is not free from doubt. The government has mounted a very strong case in terms of the president's right to remove her. One of the things that's so interesting about the Federal Reserve and the Federal Reserve Act, which is the law that governs the Federal Reserve, versus all of the other independent agencies, is that the Federal Reserve Act provides very little guidance in terms of how to remove a governor for cause. It just says the president may not remove a governor except for cause. And so what does for cause mean, right? Does it mean negligence? Does it mean malfeasance, inefficiency, so forth and so on? And does it apply to actions taken before she became governor, as in this case, or does it apply to actions after she became governor? And then on top of that, the statute is completely silent on what the procedures are, right? Does Governor Cook have the ability to go into the Oval Office and make her case, so to speak? And if she loses, is she entitled to go to a court and have that reviewed by a judge? The statute is completely silent on these issues. Whereas, at least in the context of some of the other independent agencies, the statute provides a little bit more guidance. So we're really, frankly, in completely uncharted waters here in terms of where this goes. But for the purposes of the 16th, I think it's probably a 60-40 chance that she obtains that order, at least in the interim. That's not to say, of course, that the government won't seek an immediate appeal, as it has done in other cases and so forth. So it's very much up in the air.
Very up in the air, but that's extremely helpful context. Thanks, Mark. And I think what's really interesting, obviously the Lisa Cook situation is the hallmark of the president's attack on Fed independence, if we can call it that. But what I think is really interesting is all of the regional Fed bank presidents' terms come up at the end of February 2026, and they're all set up to align that way. So how do you think about the Cook litigation and how it could influence the reappointment process of these regional Fed bank presidents?
Yeah, so the regional Fed bank presidents are elected, or they all of their terms come up in February of 2026. And the new appointees, the people that are identified to replace those Fed presidents, so that I believe there are 5 of them, one of them has to be in New York and so forth, they have to be approved by members of the board, right? Because there are 12 people that sit on the FOMC, there's 7 board members, and then 5 regional bank presidents. And those 5 are all going to be potentially new. And so you need the 7 board members to bless the new 5. And without Lisa Cook or someone in that position, you have the potential for a 3-3 split. Assuming we have a new board member that's confirmed in the next couple of weeks.
That's just another thing that I think is not well understood or priced into the market. And I feel like I've been saying this, I'm a broken record throughout 2025. None of these things are being appropriately priced into the market. And I think that speaks to just how strong market technicals have been this year. But Mark, given the recent Supreme Court rulings on agency head removals, do you expect the court to treat the Federal Reserve differently? And if so, why?
Generally speaking, I think the writing is on the wall that the Fed will be treated somewhat differently than other federal agencies. And I say this in part because, at least one of the justices has written on this topic before publicly, and the like, and I say that, and Justice Kavanaugh, one of the conservative justices, has done that. But more importantly, the Supreme Court kind of tipped its hat earlier this summer on this very issue, and it came up in the context of litigation involving 2 members of independent agencies that were fired by Donald Trump earlier this year. So there was a head of the National Labor Relations Board and the head of the Merit Systems Protection Board. They were both fired by Donald Trump. And those 2 individuals sued the administration seeking reappointment to their positions. And the lower court, in that case, ordered the reappointment or the reinstatement of those individuals. And that was upheld on appeal at the United States District Court for the District of Columbia, right? So at the lower court, the reinstatement was imposed. That was affirmed at the intermediate court. And then Donald Trump and the administration went to the Supreme Court and they sought to stay those lower court decisions. And the individuals, in response to the government's application at the Supreme Court, said, look, if you allow the firing of us, you're going to undermine the entire Federal Reserve System, because the statute that governs the Board of Governors is the same kind of statute that governs us, right? And the Supreme Court said, doesn't matter, you can be fired effectively because the Federal Reserve is different. It's characteristically different. And they said that in basically one sentence, acknowledging that the Fed is different. So the Supreme Court has telegraphed to the world that the Fed is different, but they haven't said how or frankly why that's the case. So that's very much to be determined. So I think they're going to treat the Fed differently, but it's unclear how. One additional thing I'd like to say. So the situation involving Lisa Cook, as much as we probably all feel that it feels pretextual, right? This is really about her policy views and not whether she made a misstatement on her mortgage application about whether her home was her second home or her primary home, right? I mean, let's be honest. Let's call spades spades. Nonetheless, right? This is categorically different than, at least on the surface, a policy disagreement. And thankfully, the administration and its lawyers have come out publicly and said they do not have the power to remove members of the board based on policy disagreement. So that's a good thing. So they're clearly looking for a pretext, right? And as Winnie noted at the beginning of this webinar, we all receive push notifications on our phones and the like that the Department of Justice has now opened a criminal investigation into Lisa Cook. So they're going full court press on her to try and come up with some kind of non-policy reason here. Some may say pretextual.
Yeah, Mark, I think that kind of leads me into my next question. And now that we have this Department of Justice investigation, a criminal proceeding, that does trigger due process, right? Like that's one of the foundations of the judicial system in the US. What due process rights do Fed board members have specifically for removal proceedings, right? Like how much does Lisa Cook have the opportunity to kind of go through the evidence and fight her removal from that perspective? And then how may this case actually set precedent for future members of the Fed, including the chairman and other members?
Yeah, so the short answer is we don't know right now how much process she's entitled to. As a starting matter, the statute provides zero guidance whatsoever. It just says the president may not remove a board member except for cause. And does that process mean that, as I noted earlier, that Lisa Cook has the right to walk into the White House and make her case directly to Donald Trump? Or does that mean that she has the right to go into court after her attempted removal and argue that it was inappropriate, right? And the government has taken the position definitely more towards the former, right? It's the president has the sole exclusive right to both determine the outcome and the process. So, that's really going to kind of drive this. And I'm sorry, could you repeat your second question?
No, I can't even remember.
Sorry.
Oh, that's okay. Well, Mark, do you have any other comments on the Fed? Because we do have some other things to get through, especially the tariff litigation. So do we have anything else on the Fed?
No, the thing that I'm most interested in is the split of the audience, in terms of what the market, how they may react to Lisa's ultimate removal. Or Governor Cook's, ultimate removal. One thing I will note that I thought was really interesting that I heard yesterday in the news is that at least some of the senators on the banking committee have been very clear that, and these are Republican senators, they're not going to seek to replace her until the legal process plays out. And these are more institutionalists who, believe in the independence of the Federal Reserve and undoubtedly think this is a pretext, and they want to wait and see what the courts say about this before they move ahead with any potential replacement. So that was an interesting data point that we observed yesterday.
Yeah, I mean, I think that this is going to be a really interesting overview of how separation of powers truly stands in the U.S. right now. Theoretically, we have the executive, the legislative, and the judicial branch all having some level of input in this particular situation, and hopefully that separation of powers still kind of functions as it is intended. All right, let's move on to tariffs. We have another question from the audience. Do you think that the Supreme Court will ultimately overturn the retaliatory and reciprocal tariffs? Recall, we've now had 2 separate courts say that these tariffs are not authorized under the IEEPA, and we're still kind of waiting on what the Supreme Court is ultimately going to say. So do you think it's highly likely, somewhat likely, not likely, or no chance at all? Go ahead and submit your question or your responses to this question. Just give it another second or so. All right, let's see the responses. Not likely. Majority is not likely. This is really interesting. I kind of wasn't expecting that. Zach, what do you think?
I voted not likely. Am I allowed to vote? Because I voted.
Vote early and vote often.
Winnie, it's funny. I was talking to some of our colleagues yesterday about this too, and they said, I don't care what the law says, they're never going to overturn them. So I thought that was maybe that's some of the sentiment of what folks are thinking here. So very interesting results.
All right, Mark, I'll start off with the first question because tariffs are obviously near and dear to our European investors. But I guess first off, what is the significance of the Federal Circuit's recent decision on that IEEPA does not authorize the president to impose tariffs?
Sure. Just to set the table a little bit, last Friday, as Winnie noted, the intermediate appellate court here in the United States issued a decision, a 7-4 decision, affirming a lower court decision, finding that the reciprocal and retaliatory tariffs, these are the tariffs on Mexico, Canada, and then the retaliatory tariffs on the rest of the world, which is like the 10% plus an additional amount, are not authorized by the law that Donald Trump thinks that he has the power under to issue those tariffs. And that law is the International Economic Emergency Powers Act, IEEPA. That decision came out on Friday. And I think the biggest significance and takeaway is that we have a lot of uncertainty right now in the marketplace about what this means, right? So the lower court in a 3-2 vote threw out the tariffs. And then, like I said, the intermediate court, the Federal Circuit, the U.S. Court of Appeals for the Federal Circuit, threw it out in a vote of 7-4. So we have all kinds of uncertainty here. However, overnight, last night, I mean, this is to talk about everything we're talking about right now is literally moving in real time. The federal government has petitioned the United States Supreme Court to hear the case on an expedited basis. They filed that brief late last night. I had a chance to look through part of it this morning. And I expect the Supreme Court to take up that case in the very near term. So we fully expect that the Supreme Court will be hearing arguments on that case in the coming months, and a decision will likely follow shortly thereafter. So in the interim, the only thing that's certain is that the tariffs are going to remain. All of the rulings have been stayed, so importers are going to have to continue to pay the tariffs in the interim. But in terms of the long-term predictability, there's definitely some uncertainty about that.
Yeah, definitely some uncertainty. When that decision came out last Friday afternoon, I was texting with a neighbor and friend who has a small retail establishment here in Charlotte, North Carolina, and Christmas season is coming, which is one of his big seasons. And he was like, man, if we could get those tariffs rolled back, I would be saving so many millions of dollars. So I really feel for him, and Mark, it seems like refunds are not forthcoming.
Yeah, I mean, they're certainly not forthcoming until like the dust settles on all this, right? So there's a ton of uncertainty. The only certainty we have is you're going to have to pay the tariffs if you want to bring in goods in the near term. And, you know, we get all kinds of inbounds about what about refunds? How does that work? We hear stories and we read about how there may be markets right now in trading of refunds, to the extent that at the end of the day, these are ultimately held to be unlawful. And that very well may be the case at the end of the day. There may be entitlements to refunds, but, you know, that's, you know, 3 carts before this horse at this point. So.
All right, Mark, last question on the tariff topic. So if the Supreme Court does rule against the administration on IEEPA tariffs, and is this the end all that we hear about tariffs, or are there other statutory tools that the government could continue to use to impose tariffs?
So the short answer is this is not the end all be all. The various administration officials, you know, over the last few months, ever since the court started to get involved, have been steadfast in their determination to continue to impose tariffs, regardless of what the Supreme Court, for example, ultimately holds, right? And, you know, the administration does have a lot of tools here. There are a number of statutes that allow the administration to impose tariffs. They're a bit more constrained. They're shorter in time. They're, you know, the limits of the tariffs are less. There are more procedures they have to go through. So that's one tool they have. They can issue additional executive orders that would need to be challenged in court, right? One of the things that we've been talking about as we write about these issues and we think about these issues, the administration has the ability to act very swiftly, right? The administration can impose these tariffs with this, you know, stroke of a pen, and it can change overnight, right? And that's one of the problems that we have with predictability. But the court process is slow and deliberative and so forth. And right now, the court process is going absolutely as fast as it can, but it's still very slow. So, you know, the administration has the advantage of speed here. So I think at the end of the day, you know, a win ultimately may you know, appear to be a Pyrrhic victory for some of the importers.
That's great. Thanks, Mark. And we have another question from the audience. We kind of touch on it here, but I'll just read it directly. Many have said the administration can reissue the tariffs under different laws. Would the tariffs collected under IEEPA have to be repaid, or would it remain in place retroactively if the law used changed?
So my expectation is that if a tariff is collected under the auspices of IEEPA, and it is determined that that was unlawful when collected, you would be entitled to a refund of that tariff at that time. On a prospective basis, however, if the administration asserts authority under a different law, for example, then you'd have to pay it under that different law and then fight about that after the fact. So my expectation is that they would probably be entitled to refunds. But again, you know, I'm not your legal expert, and I'm sure lots of people are going to weigh in on this in the months, and hopefully not, but maybe years to come.
Yeah. So the other big topic that or one of the many big topics is government intervention and ownership in private companies, and we've seen that directly with Intel and the government taking a 10% stake recently. Mark, how is that even possible, and is it legal?
So it's a great question, and it's a hot topic, and frankly, I think in some ways it's a bipartisan issue, right? I mean, a lot of people think this is a really great thing that the government should, as a people, we should all collectively benefit from, equity ownership in companies here in the United States. And the short answer is that Treasury and the government is allowed to do it as long as there's a law that authorizes them to do it. And so, we go back to the founding of our republic, and there are all kinds of instances over the years where the government has either received or invested in private enterprise for one reason or another. And they usually, revolve around times of crisis or in a situation where the government needs to get involved in order to prop up or save an industry. So, we have all kinds of examples of that. And an example that, many people who are listening today or who will listen to this in the future may remember, or at least you've heard about, is during the Great Financial Crisis, Congress passed a law known as the Emergency Economic Stabilization Act, which created something called TARP, or the Troubled Asset Relief Program, which allowed the government to go out and buy troubled assets of all kinds of financial institutions in the United States. It allowed them to take equity interests in companies like AIG and to provide bankruptcy financing for GM and Chrysler. So the short answer is the government can do this without any problem as long as it has an authorizing piece of law that lets them do that. And so sometimes Congress will pass a law that says, go out and do X, Y, or Z, go buy this company or do this. Or other times they'll pass a law that's more vague, that's kind of open-ended, that says, use your discretion to do what you think is necessary. And so in the case of Intel, for example, it was the CHIPS Act, which I believe was passed in 21 or 22 a few years ago, that, was designed to bring, micro chip processing into the United States. And the Treasury and the government thought they had the statutory authority under that law to purchase a 10% equity stake in Intel. So that's how it works. And look, and you guys are probably closer to this than me, but you hear, the government has thrown around ideas of creating a sovereign wealth fund or, going out and buying, other interests in different companies. And that's perfectly, doable so long as there's authorizing legislation that lets them do that.
So Mark, it seems like back during the financial crisis, it was perhaps a bit clearer that the law that you just outlined that kind of authorized TARP was a little bit more clearly directed toward the government getting involved in these troubled companies. What's your assessment of the CHIPS Act, and if that truly did give them authority to make this investment in Intel?
Well, I don't want to get out over my skis because I haven't studied the authorizing legislation under the CHIPS Act for purposes of this discussion. But I can say that the government felt comfortable with it and Intel felt comfortable with it. And there's all kinds of very smart, sophisticated lawyers that are looking at that. I mean, one of the issues that the markets, the equity markets in particular, should be aware of is that, to the extent that the government comes in and starts, buying large equity interests in companies, that potentially, without legal authorization, potentially could create issues regarding shareholder lawsuits and so forth. So.
All right, Mark, let's turn to the Supreme Court, because we'll be getting into the October term any minute now. We're in the Burr months. How exciting. What Supreme Court cases are you watching for the upcoming term, which starts on October 1st, and how might they impact financial markets and government powers?
So this is actually a perfect way to end our discussion today is talking about what's on the agenda for the Supreme Court. Now, so the Supreme Court hears cases in the ordinary course every term. They hear, X amount of cases, 60 or 70, not a lot. It's not a lot of cases. But just to put into perspective what's going on in the lower courts, there are approximately 390 plus lawsuits currently pending in federal court against the administration related to various policy changes and actions by the government. and they raise all kinds of novel issues, everything from, impoundment, which is when the government decides not to spend money that Congress told them to spend. We've got the tariffs, obviously. We've got Fed independence on the one hand, and also the ability to fire independent agency heads of other so-called independent federal agencies. So those are all cases that we think are going to be really, really important from a macro perspective. So those are some of the big themes and cases that we're following. But look, of those 390, there could be several other that make their way up to the court in the near term that could have a substantial impact. But in terms of specific cases, cases that I follow, in addition to following macro legal issues, I also follow a number of important credits at the credit level. And there are two cases that I think are going to be ripe for decision this year, and that one relates to Monsanto and some of its issues related to its massive hundreds of thousands of lawsuits, and that'll be really impactful for Monsanto and Bayer, which is its parent company. So that's going to be a really big ticket item that we're going to see at the Supreme Court next term. And another case that I've been following very closely for, frankly, a number of years relates to Hertz and some really interesting issues about whether bondholders are entitled to post-petition interest if a company files for bankruptcy. So that's going to also be a really important issue for the financial markets. So it's definitely evolving. There's going to be all kinds of things to talk about. It's going to be, in my prediction, a blockbuster year at the Supreme Court, and it's going to be great.
A blockbuster year. Get your popcorn ready. One last question for you, Mark, related to the Supreme Court from the audience. As we're thinking about the composition of SCOTUS, what are you thinking in terms of alignment with Trump, conservative versus liberal split? Have you seen anything that kind of makes you think that perhaps the traditional lines are not necessarily going to be followed? What's your view there?
Yeah, so I think in terms of the Supreme Court, I think there are 3 justices that are firmly in the liberal camp, if you will. I think there are between 3 and 4 justices, depending on the issue, firmly in the conservative camp. And then I think you've got a handful of justices, 2 to 3, that are in the middle. And it's really dependent on the issue that comes before the court. We've talked about, I'll finish on tariffs as the perfect example. The tariff case does not fit neatly along political lines. It's in many ways just an issue of interpreting the statute itself. And if you apply traditional statutory interpretation principles that the court has applied in countless cases, one would lead to the conclusion, I think, that the statute does not authorize these tariffs. And in fact, both lower courts, by large majorities, have held that. And so if that were squarely presented to the court, right, you can see a world where conservative justices, based on their logical principles in the past, would have to side with the importers in this case. But look, the court is made up of humans who have, biases. So it'll be real interested to see where this ultimately plays out.
Absolutely. So interesting to see where things ultimately play out. But really, my top trade for 2025 was let's be long lawyers. I think I'm going to maintain that going into 2026, given all of the cases that are still pending. Mark, thank you so much for joining today. Thank you, everyone, for joining this CreditSights Global Market Update. Like I said, go take a look or listen at those special episode podcasts celebrating our 25th anniversary. Thank you for being CreditSights clients. If you have any questions for us, please feel free to reach out to us directly. And with that, we will see you in late September for our 2026 preliminary outlook. Get ready. Thanks, guys.